The world's biggest central bank, US Fed, has decided to stay course. They've cut the monthly bond buyback purchase program to $15 billion and have reaffirmed that interest rates in US are likely to remain low for the foreseeable future, which is a big relief for all those who thought in the near term Fed could move aggressively and that could have an impact on global liquidity. Those comments from Fed are have helped US markets last night. Asian markets are bouncing back and we could be in for a decent start at least this Thursday morning.
Oh yes, and markets have cheered that the fact that US Fed has reiterated that it will raise rates once a considerable time has passed after its stimulus program ends in October. As was widely expected, the Fed committee voted to reduce its monthly bond buying program by $10 billion. If the economy stays on its current path, the QE will end next month as per plan.
Regarding interest rates, the committee reaffirmed its forward guidance that it likely will be appropriate to maintain the current target range for the federal funds rate for a considerable time after the asset purchase program ends, especially if projected inflation continues to run below the committee's 2% longer-run goal and longer-term inflation expectations remain well anchored. This judgment is based on the committee's assessment of realized and expected progress toward its objectives of maximum employment and 2% inflation. An assessment that's based on a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial developments. I want to emphasize that there is no mechanical interpretation of what the term considerable time means. And as I've said repeatedly, the decisions that the committee makes about what is the appropriate time to begin to raise its target for the federal funds rate will be data dependent.